Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for November 2nd of 2025. I want to get started off this week with a chart kind of depicting what is kind of commonly known as the K-shaped recession theory. And so you can see here in the two lines that are overlaid, red line here is the S&P 500 price index. It's just basically index values over time, and overlaid against that is the University of Michigan Consumer Sentiment Index, which you can see very clearly here is moving in kind of the opposite direction. And so this will be a little bit of a theme that we'll talk about today is, this dichotomy of the wealthy cohorts are actually feeling fairly good about things, whereas the lower income cohorts are not. And so you can see the sentiment index here is kind of meandering down with some upward movement, but you can see the kind of this gray K line that's been overlaid against that. So you look at 2020 and the pandemic and see what's happened since then. This is what people are kind of referring to as the K-shaped recession theory, is that you have the lower income cohorts that simply aren't doing as well or feeling as good as the upper income cohorts are. Okay, we've got some more economic data here for you. This data also from the University of Michigan, but this is the consumer confidence outlook for prices. And so what we have here, two data series going all the way back to 1979. The first is the pink line, which represents consumer price index. You can see how that has transpired over time. This is on the left-hand scale, so you can see, line of best fit probably is kind of in that 2.5% range, maybe a little bit more than that, 2.6 over a longer period of time, notwithstanding the period at the beginning of the 80s when we had very high inflation. Now, overlaid against that is this blue line, which is kind of a subset of this. It kind of breaks out CPI from the components that have had 15% or more increases in prices from those that have had relatively benign price increases. And what's interesting, and you'd expect there to be a positive correlation here, but what you did not expect is that you've got components of the index that have had very dramatic price increases relative to the pace of the overall rate of inflation. And so this goes back to that theory that some of those components that have had fairly dramatic increases in inflation are impacting the lower income cohorts. So on this slide, we have the CPI, which we were just looking at in the blue line, and then we have core CPI in this red line here. And so you've got this dotted line here represents the Fed's 2% target. We know that inflation is running hotter than that, so inflation is somewhat sticky. The trajectory certainly has been down over a period of a couple of years, although those increases are starting to rear their ugly head again. And some of this obviously is related to the impact of tariffs, not exclusively, but I'd say the trajectory would continue to be sliding down to 2% if it were not for tariffs. But this continues to drive home the point that the Fed's job is really hard because they want to maintain stable employment. We know that labor is certainly easing a bit, and companies aren't necessarily firing people, but they're certainly not hiring them either. And so we're at a point of stasis there. And so the Fed has kind of pivoted its thinking to some degree on that side of the dual mandate, and they've really kind of, for the time being, said, listen, we're going to focus on labor. We know prices are higher than our target, but I think it makes their job hard because if we continue to see little micro increases in inflation, it could give some pause to their actions on reducing rates, which is really the theme that at least one of the themes that Fed Chairman Powell was talking about this week in his comments after the Fed rate cut decision this week. The various other things that we look at, credit quality, the health of the consumer, obviously very important to to the economy because consumption represents 2/3 to 70% of the total economy. Here we have a chart that was published in Liz Ann Saunders, some of her postings on LinkedIn, pertaining to credit card debt per median household income. And you can see here in the darker red areas represent some of the areas of the country that have higher credit card debt levels as a percent of median household income. And you can see here, some of the lighter states here that maybe that's less so, but think about the most populous states, certainly Florida and Texas, so a lesser degree California. New York is kind of in that kind of that mid category, but again, something that we monitor and just also drives home the point too that even though we spend a lot of time with national statistics, that there are a lot of economics that is inherently local. Here we have sentiment. Again, we're talking about consumer sentiment, and this kind of relates to the dichotomy of high income folks versus lower income folks. And so here's a sentiment level, say for people with large stock holdings right here. And this is the top tercile. So, think about that in terms of threes. And so sentiment higher here than clearly than it is with folks that don't have any stock holdings. And so, while this is not like a perfect income correlation type metric, people in lower income cohorts typically have less stock holdings. And in the case here, they have none. And you can see here that, not unusual to have divergences like we have now, but it just shows you that the different parts of the population are in different places. We have another one of those color shading charts. This is the 12-month change in grocery prices for the state. Very interestingly enough, Pennsylvania comes out at plus 8%, which is pretty dramatic. Again, just like I said a few slides ago, a lot of economics is inherently local. That's certainly the case when you get into some of these northern states, less so on the southern states, but you see Florida, which also had high debt per debt service per capita or per income there, is also high on the grocery side as well. The chart here, we've got basically a whole bunch of inflation metrics on one chart, and it really kind of solidifies and crystallizes kind of our thinking on this, because you've got, not only do you have CPI, core CPI, and you've got producer prices, PPI, and core PPI, but you also have personal consumption expenditures and core PCE, all overlaid against the Fed's target. And so again, just like I was saying a couple slides ago, the Fed's job is really hard right now because inflation, if anything, is kind of like eking up just a little bit. After really, I'd call it a solid year of just kind of like meandering. And, there's a lot of unknown with regard to tariffs. We've had kind of a rolling tariff impact. And so it's not like, everything was announced in April and all of a sudden we had this burst of inflation. That certainly has not been the case because some companies have absorbed the hit. Some companies have passed it along, and not all industries have witnessed the same level of impact. And so as a result, you see these modest changes in inflation as a result of it. But you can see all of these measures, whether it's these more conventional kind of publicized measures or PCE, which the Fed spends a lot more time with, particularly on the core side, backing out food and energy, that you see that all of these things are coalescing in kind of a 2.5 to 2.7 to 3% range right now. Got more data from the University of Michigan. This is a actual expected inflation rate over a couple of different time periods, which are obviously very important to us. So first of all, in the dark line here, we have the expected inflation rate for next year, which, again, not too surprisingly with tariffs, went sky high there for a while. And then we realized, all right, well, maybe all this stuff is not going to really come to pass. And, there's a lot of jawboning. There's a lot of there is a fair amount of real impact, and we'll see that here coming up. But just the expected inflation rate's kind of sitting at about 3.3 right now. If you look at next year, now if you look at 5 years out, that number right now is closer to 4, and so that's kind of, I'd say, in some respects concerning because it does help to condition behavior like long-term decisions, et cetera. It may actually condition them the other way, thinking that prices are going to go up by 4%. We need to spend the money now. So it's very difficult to ascertain, but you can see where we came from to 2014. We had inflation expectations that were really well anchored, and we get to the pandemic, and then we had hyperinflation that kind of drove these numbers, quite a bit higher. Then they went back down, and then we're in this kind of this tariff unknown with regard to near-term and long-term expectations. Small business optimism. This is a particular component of that is in that survey. It's asking small businesses, are you planning to raise prices? And so the percent that are planning to raise prices is sitting about 30% right now. And so, this goes back to the expected inflation rate that we just looked at. Again, this has implications on, capital budgeting. This has implications on, a lot of decisions, expansion, so on and so forth. If you expect inflation to be higher, both at the consumer level and on particular, for small businesses, whether they feel like they need to raise prices to recapture margin and things like that. Right now, you look back in 2021 when we had the burst of inflation, and that was kind of, businesses having to play defense to the inflation that they saw. They had to raise prices. That was less so last couple of years, but I think one of the key takeaways here, even though we've seen that kind of increase, it's not out of line with what we've seen over the last several years. Again, 2021, 22 notwithstanding, but obviously something that we want to track over time. So in some of these kind of like not mainstream data points, we have TSA checkpoint data. So we've had the shutdown for a month now, and this is essentially 2021 to 2025. Really not much impact here. I mean, we're seeing in terms of where we are in the course of the year. I mean, we're really at highs. We've got a lot of traffic. We've got a lot of travel. People are on the roads. People are in the air, and they're moving around. So we haven't really seen impact either from shutdowns, and that's a monthly deal. And this has some seasonality to it, but again, not much impact here yet, at least insofar as air travel is concerned. This chart, we have the evolution of the effective tariff rate, and we were talking about that a few slides ago. Where that stands right now is the effective tariff rate's about 15.75, 15.74 to be exact. That was obviously not the case in April when all the tariffs were announced, and then President Trump backed off a lot of this stuff and quote unquote cut deals that were never really codified, just kind of basically a lot of rhetoric, and so that went down. And what we've seen here over the last few months is that's moved up in percentage terms, probably a little meaningful. But when you talk about going from kind of a 12 to 12 and a half to 15, almost 16% effective tariff rate, that does have some meaning. But again, it looks like it's leveling out here, and all we can hope is that we don't see a burst of tariff related activity here over the coming months. We'll switch to the housing market. We have FHFA House Price Index. This is monthly data. You can see very interestingly enough, we had a spike after several months of price decline. So we know that the housing market has been challenged quite a bit, and by and large, you're going to see price increases. That's why housing in many respects is a good hedge against inflation, but we haven't seen that lately, and this has been kind of the first time in quite a number of years where we've had several months of consecutive price erosion. But that is certainly turned around in the most latest reading. Okay, so moving on here, a chart I've shown you in the past is that it looks at the U.S. stock market's influence on the global markets, and you can see very clearly here that the U.S. Market share of the global stock market is almost 50% and has been moving up consistently since the global financial crisis. We have profit margins. This is another very interesting and telling chart. So you've got essentially the Magnificent Seven or the S&P 7 in this chart. You see margins maybe coming off a little bit, but remaining relatively high. These are 2025 consensus profit margin estimates tracking through the months here. And then what we're seeing very clearly is that the rest of the index that's not the Mag 7 has had some erosion since the beginning of the year in profit margin estimates. And so, again, we have a market that is narrowly led in many respects from those high-flying tech stocks. And really, it goes beyond the S&P 7. I mean, when you talk about companies that have related technology exposure or they feed into the technology ecosystem, this number is maybe a little bit higher, and the weight of those within the total index is almost 45%. And so again, there's kind of a tale of two parts of the market here. Tech's contribution to return accordingly, looking at that last chart, is going to be profound, and we can see that here in the S&P line, and then if you back out information technology and you back out technology and communications, you can see that those numbers are considerably lower. As you track and you assume that essentially the 14th of 2005, which again that's 20 years of data. You can see that it tracked very closely until we kind of broke out really before the pandemic, and it's only accelerated since then. Now we've got the percentage of S&P 500 members that are actually outperforming the index. This is basically a measure of participation in the upside. And so, we went through really a number of years where we had some pretty meaningful again, going back to 1995, some years of very meaningful participation where, is very broadly based. And you can see, we've kind of hugged around the upper 40s to mid 50s. So, fairly decent participation. And then that dropped off significantly for a couple of years in 2023 and 24. 22 was 57, but unfortunately, most of that was on the downside. Now, we have seen greater participation in 2025, but again, I think it's very important to understand that the market is still, despite this, it's dragging along some of the rest of the 493 stocks in the S&P 500, but we still have an outsized influence from the top 7 companies in the index. Talk about credit exposure. We've got a few charts here. Pull this out of some Goldman Sachs research just to kind of bring us up to speed. We've got basically 60-day default rates for auto. These are asset-backed securities. So think about auto loans that are sold into the second, or that are packaged and sold into the secondary market. You've got prime borrowers here, subprime borrowers here. As you'd expect, prime borrowers are the ones that have the best credit score, and you can see 60-day default rates kind of eking up over a period of years, but remaining relatively low. Whereas the subprime market, you can see a little bit of erosion there in terms of credit quality. If we slide over to the mortgage market, we have, again, 60-day default rates for mortgages by, prime Freddie Mac mortgage-backed securities. You can see here, fairly low, not much of a change, really. We don't really see that much of an impact there. And then, if we look at VA loans, we had a little bit of a bump here as we did in FHA loans and within Ginnie Mae's. But overall, not as much of an impact, although you can look at FHA loans here, and that's moving higher. We'll do a little bit of a deeper dive in FHA here because that tends to represent some of the less credit-worthy borrowers. But again, mortgage market not completely unhealthy. Auto loan market, maybe some erosion there that we'll need to pay attention to. On this slide, we have auto loan delinquencies kind of sliced a little bit differently. We're looking at basically credit levels on the preceding chart. This time we're looking at age cohort. And so what you see here, data series going back to the beginning of the century, that we had kind of a trough in delinquencies in 2022. It's picked up since then. You can see the greatest amount of gains are here in the 18 to 29 and 30 to 39. So just think about the young professional delinquency rates are moving a bit higher, 40 to 49. You can see that essentially they've all moved higher, but you can see for the older age cohorts that they're either flatlining or moving lower. And so, as we're looking at auto loans and really keeping track of that, we really want to drill down and pay attention to the younger cohorts. These are people that are getting degrees and not necessarily finding jobs. And, they're going to be an important driver of overall credit quality here over the next 10 years. And so, obviously, with these younger folks, we want to make sure that they're getting off on the right start. So continuing on this conversation about credit quality, we have credit card transitions to serious delinquency, and that's defined by over 90 days. Again, by age, and not too surprisingly, you can see the 18 to basically 18 to 40 range up here. And interestingly enough, kind of a flipping of what we saw in auto loans, we saw credit card delinquency transitions here like a little bit higher for the older age cohorts, which a little bit unusual, but I think maybe a positive takeaway here is that as we enter the new year here, 2025, which is actually almost over with, that we began to see some declines in some of these delinquencies on the part of the younger cohorts. Default rates on loans and high yield also coming down. So, if you're looking at various read-throughs on the economy, one of the positive takeaways is that the perception of credit quality, at least as it's kind of echoed through the bond markets, is really pretty favorable, all things considered. You can see how, credit spreads and default rates tend to move with the economy, and you hit a recession, and those things tend to blow out a little bit, and it's a fairly good indicator there. But again, at a time where we thought maybe we're going to have a recession in here because these things were perking back up, and it was really almost a false signal because maybe they peaked and now they're seemingly moving down. So with all the conversation about credit issues or credit quality on the auto loan side, on the mortgage side, I think it's really helpful to look at the health of the banks right now. Whether or not you believe that we're heading into some kind of an economic downturn, and if you are, then you certainly are concerned with where the banks are. And the key read through on this slide is that the banks are in really good shape, all things considered. So when you look at capital ratios, and this is like capital strength to withstand credit quality erosion, and you look at basically institutions with varying levels of assets on their balance sheet, but they're all higher really than they were back preceding the global financial crisis. And then you look at loss coverage ratios. Again, these are various components of the financial spectrum. You've got credit card lenders, mortgage lenders. In some cases, they're one and the same. Then you've got other specialized lenders, commercial consumer. You see all of these institutions are in relatively good shape from loss coverage ratios and on overall capital. More good news here. We were monitoring this for a while and kind of like really paying attention to some of the elevated bankruptcy filings relative to post-pandemic, but kind of pre um, pre-market downturn in 22, that these bankruptcies, if you look at the 12-week moving average, and this is really the more smoothed out line, which moving average would typically do, you can see that it's moving down. And so I think that's pretty meaningful in this environment. That's one of the things that you look at if you believe that there's some stress in the market is what those bankruptcy filings are, considering that we've had a lot of new business formation at the small company level over the last several years. We've got a chart that I pulled out of Deutsche Bank research, which I thought was really, really telling. And and you get down to it, this is long-term data, 1800. And you look at really the relevance to economic growth to equity returns. And so obviously a lot of work went into this. So you've got global, you've got developed market, and then you've got emerging markets here. And so, um, I mean, the bottom line is that economic growth matters. We often talk about how in the short term, like economic trends may kind of run counter or maybe not run in sync with equity market returns, but they usually will sync up over time. Well, this is a chart that kind of highlights that because you might have some deviations over time, but over long periods of time, growth in the economy absolutely matters to stock performance. And you can see, here you've got rates of growth both in GDP and stocks, and you can see the rate of growth in stock appreciation across the globe has decelerated somewhat as we've seen deceleration in growth. Developed markets, again, this includes the U.S., but includes a lot of other countries too. Same deal here as you see in emerging markets. So we're going to pivot here and talk about technology for a little bit. This is interesting data that I came across in some research this week from Deloitte Insights in their 2025 survey. They look at trends in semiconductor revenues. Now we've talked a lot about chip building related to AI and NVIDIA, so on and so forth. Intel to a much lesser degree, but you have a lot of companies that are seeking to get into the AI chip business. But you can see the forecast here, very healthy. Looking at maybe 5 years of historical data here, and where we think we're going to go. And by this estimate, we're looking at basically $1 trillion here in the next 4 years. So now I want to spend some time on alternatives, as we as a firm are doing a lot more work in alternatives. We're doing a lot more research. We have more ownership in client portfolios of alternative investments, and you can see some research here from Goldman Sachs, which I thought was really, really interesting because it kind of breaks down the usage of alternatives in portfolios depending on your age, depending on the size of the portfolio. In this case, we look at both of those things. So just real quick, if you look at really small size portfolios, you see, here breakdown by asset classes. You've got alternatives in the green. You can see, smaller portfolios about 8%. You get 12%, and then 15% as you get into higher, larger size portfolios. And what's interesting here is the cash allocation is kind of around 20%, and you see where people are taking money from, is not fixed income, it's actually equities. So they're taking money out of the equity market and putting it into alternatives the higher you go. And consequently here, you see a relative divergence in the use of alternatives between younger investors, these are the millennials, and the older investors, a silent generation. You got your baby boomers, and again, it increases over the spectrum. And then you see a lot more conservatism in the silent generation, which not surprising at all, right? Because this is all age-based asset allocation. But the takeaway here is that you have really an awareness maybe not as much of an understanding, but you have a willingness to use alternative investments in the younger age cohorts. Now we have allocations by wealth tier to alternatives, and this dovetails real nicely with the chart that we just looked at. If you look at basically $20 million households, and 91% of them are going to have some level of alternative investments, whether they're direct investments, whether they're fund of funds, whether they're kind of indirect investments through maybe ETFs or things like that. And that is far in excess of the smaller household investments or allocations into alternatives. And then private real estate is the leader in that category. So, just think about like as you get into larger households, a higher percentage of those households are investing in alternatives. Where are they going? Well, obviously private real estate, private equity, growth equity, and private credit. These are all areas that we have looked at. Obviously venture cap is a little bit more speculative. Hedge funds, which were the kind of alternative darlings about 15 years ago, again, kind of replaced by some of these more nuanced areas that have really come on the scene over the last 5 to 7 years. So another thing that we want to look at with wealthy individuals is the savings rates, and we know that essentially 50% of all net consumption is driven by really the top percentile or the top handful of percentiles of the wealth spectrum. And we can see here that wealthy individuals save a lot of their income, and they actually hold a lot of their net income in cash. And so this breaks it down into, again, the categories we've been looking at, the 1 to 5, 5 to 10, and the over $10 million households. You can see savings rates increase by the level of, essentially by the wealthier families, and that makes sense because, they're making much more than they're spending here, and so they have net higher savings. But this is also interesting that they also are holding a lot of their wealth in cash. And we do know that money market balances are extremely high right now. This does represent potential allocation into overall risk capital at some point. I think this is just where they are right now. And I know this has been lower and certainly been higher during more stressful periods, but it does represent an opportunity for investment. Again, not just in the equity markets, but in some of the private markets, as we've just seen. Look at a breakdown of household expenses. We see here in the blue shaded areas, this represents the largest expense. Not too surprisingly, it would be home-related costs in this case, and then taxes, and then lifestyle spending. You think about travel, automobiles, and then some of these other things that are maybe a little bit more discretionary, but you see clearly home costs, mortgages, property taxes, and insurance are either the largest or the second largest expense, followed by taxes in various forms. So, talking about alternatives, what are the most important reasons why people are getting into them? As we saw, the upper income cohorts, the higher net worth folks tend to have a greater concentration, a higher percentage of them are invested in alternatives. Well, why are they doing it? So, here is a ranking of that, again, within that Goldman Sachs research. They're looking for performance. That's either the first or the second or third most important reason why they're doing it, and 44% respond. So that's very important, as is diversification and reducing correlation to the public market. So this is a risk tool that they're using it for, which is I think in these two cases are very important. And cash flow, a lot of alternatives do generate very good cash flow. And then here's recommended by their financial advisor, which again, we'd like to educate our clients. So we'd like to educate them that these are reasons why they should want to do alternatives and not just take our recommendation for it. But then you get down here into some of the more kind of nuanced reasons why they do it. Hedge against inflation, which I think is relevant. and then values-based investing. So that's very interesting because this would not have been a category in this kind of a survey about 10 years ago. But you can see, as you go up the scale here, these are the most important. Access to unique opportunities is another thing, and we do know that the size of the private markets is a multiple of what's in the public markets. So a lot more options there. More of this great research from Goldman. Again, these are surveys, so this is really good data and feedback for us as advisors to the investing public. So when you look at the definition of risk and how people perceive asset class risk, you can see you've got U.S. public company stocks, and then gold, and then bonds. These are kind of like the bedrock of a lot of our investment tools, as well as equity mutual funds and ETFs. Very high risk. I mean, obviously, stocks are going to have a higher risk profile than either gold or particularly bonds, whereas bonds and gold tend to have a very high perception of being low risk. But we get into alternatives. What's very interesting is that, and this is a reason why some of the lower income cohorts haven't really embraced it yet, is that you have a relatively high percent of people that still view alternatives as very high risk when the structures of these investments and these types of investments has really evolved. And I think you're not going to see those higher level adoption rates on the part of lower income and lower net worth investors until this changes a bit. And then if you slide over from alts to cryptocurrency, then of course here you see the overwhelming majority of folks view that as very high risk, which I would concur. All right, data centers. The United States dwarfs the rest of the world almost combined, and you can see that we're investing a lot in data centers. We're talking about investing a lot in data centers. We see a lot of capital spending plans on the part of large technology firms that are going kind of like in this reciprocal investment cycle. They're investing in other firms that are then investing in other technology firms, and so on and so forth. So how high can this number go? And we're obviously putting a lot of effort into maintaining our leadership there. You can look at China here, basically a distant fourth in this particular ranking. Public companies and the supply of public equity, we've noted over several decades has gone down. At one point we had 8,000 publicly listed firms out there, and now that number's less than 4,000 public equity firms, firms that have stock that trade publicly in the open markets. And consequently, we've seen a higher degree of public companies that are being taken private for a lot of different reasons. One, they can avoid the public disclosure things that they're compelled to do by the SEC. They can operate a little bit more in a kind of a closed vacuum, so to speak, where they're not under scrutiny for decisions that they make that are reported in their public filings, so on and so forth. But there is a lot of capital that's sloshing around here, and so to be clear, this is not a trend that just started like a year or two ago. I mean, this has been well entrenched over a number of years at a time where the amount of public equities has also gone down. Another interesting chart that I think is worth noting as interest rates kind of settle in a little bit here. Now they've come down a little bit, but they're higher because of inflation. They're higher because of tariffs overall than where they were. But I think what's really important in this is that for a long time we were talking about the fact that a lot of people had mortgages below 3%, and that was around 5%, call it, and then that went up to around 20 to 25% when pandemic and interest rates came down. A lot of people refinanced at lower rates. And so, here we have below 3 and then 3 to 4%, and that number actually went up, and now, but those numbers have been coming down as more people. The farther we've gone, where we have interest rates that are not 2% like they were, the longer we go, the more, there's going to be mobility, and people are moving for job reasons. They're moving for a lot of different reasons, and they're taking on new mortgages at higher rates. And you can see here that greater than six had been trending down at a point where these low rate mortgages were going up. Now, as of 2022, we see that inflection point where now those higher rate mortgages are increasing in the share. They've gone from basically around 10 to 20% of the total. So I think it's clear that over time, as these higher overall levels of interest rates are further entrenched, and people's memories continue to be short, and they forget about the glory days of 2.5% mortgages, that this number is going to continue to rise. Here we have small business optimism index. Now we looked at some small business indicators earlier in the chart pack. You can see here optimism is higher than it was, but we have a divergence again. So it has not been reflected in the Russell 2000, even though the Russell 2000 has picked up a little bit recently here. This amber line here actually represents the ratio of the Russell 2000 to the S&P 500. You can see that we've had this continuous erosion, meaning the relative outperformance of the S&P 500 to the Russell 2000 at a time where small business optimism has actually picked up. Here we have interest rate sensitivity. This is pertaining to the office and the commercial real estate market. So here we have private construction spending for data centers and general offices. As I just mentioned, we've had like a massive amount of building and data centers that we lead the rest of the world combined in the number of data centers, and we're still building them. So in terms of private construction spending, you can see here that office spending has really gone down at the same time that we see this continued rise in data centers. So when you look at commercial overall, it looks fairly benign, but the offsets are less office and more data centers. And at some point, we've got an inflection point here, and the market will change at some point. And then at some point we will, I think, experience a more benign rate of gain in the amount of spending in data centers over time. Private fixed investment, you can see that's a little bit over the map here, but the key takeaway here is we got information processing spending that's moving higher. Meanwhile, residential and non-residential overall going a little bit lower, again, notwithstanding the fact that we've got data center investment. But we do have a pretty high level of spending in overall technology equipment. That would be, basically, switches, routers. It would be computing equipment. It would be, all sorts of equipment along the technology spectrum remaining relatively high. We have China's gold stock level. You look at the myriad of reasons why maybe gold prices are higher, even though they've come off about 10% from their peaks. Certainly one reason we've seen China as it's trying to move away from U.S. denominated debt. You can see the continued erosion in that level. At the same time, you're seeing an increase in the acquisition of gold for stocks as a backstop to the yuan. Very interesting chart here, and we're getting close to the end. We've got U.S. Treasuries as a percent of foreign reserves, and I think if anything, this will be accelerated by the new administration. But in its relationship to the global banking and central banking sphere, but foreign reserves, U.S. Treasuries, held a very preeminent place for quite a while. And that has eroded over time. And again, this is not necessarily a byproduct of the Trump administration, because it was going on for a little while beforehand. You can see here, but obviously gold with its prices moving higher, and as we just saw the Chinese, the acquisition of gold for its reserves, that moves higher. That we're almost at that inflection point where central banks own more gold than they do U.S. Treasuries. This does have implications for the demand for U.S. Treasuries to some extent at a time where we're running high deficits and we're having to issue a lot of supply. So, again, I wonder like who are your natural buyers going to be in 5 years, and how much, if any, different are they going to look than those natural buyers of today? Last slide here, business uncertainty, and kind of plotted against gold prices. Gold is still a hedge when you have uncertain times and when you have tariff tantrums, and you have kind of general global uncertainty on some things. You're going to see you're going to see gold prices impacted, and in a positive way. So you've got basically this line represents small business uncertainty. That has moved higher over the number of years. But you've also seen gold prices achieve new relative highs in that period too. So if you go back to 2019, you have to take stock of this positive correlation between these two. That's all we have in the chart pack this week. Hope you have enjoyed it. Have a great week, and we'll talk to you again very, very soon.